Constant research and fine-tuning is a core part of GrowthShares. In this video, we're going to discuss and go through all three factors and all 11 metrics that accompany it. I want to simplify everything and make investing accessible to everyone, but I still want to keep the complexity with what I look for when analyzing a company as a long-term investment. That's why by fine-tuning, the numbers are what they are to make an optimal analysis. Every company I analyze would consist of these three factors: the business, the stock, and the price. The business is 45% of the analysis, and it basically asks the question, is this company a good business to own? The most weight is put into the business because as a long-term investor, the most important aspect of my analysis is the fundamentals of the company. We want to own a good company. There are 6 metrics that make up the business factor, from growth and efficiency to market dominance. Each are weighted based on importance to the business. The stock is 35% of the analysis, and it basically asks the question, will the company's stock perform well enough in the future to justify an investment? The stock is given this weight because it's nice to own a good business, but we also want to see the stock perform well enough so that our net worth can grow over time. There are 4 metrics that make up the stock factor, from performance to Wall Street. Each are weighted based on importance to the stock. The price is 20% of the analysis, and it basically asks the question, what is the most you should pay for the company's stock? The price is given the smallest weight because many investors put too much importance on the price. It's important to buy at the right price, but it's vastly more important to get a good company first. There is only one metric, the intrinsic value. Each of the 3 factors and 11 metrics are given a grade from 0 at the low end to 99 at the high end, with a grade of 50 to 59 being considered average. I want to stress that most companies are average long-term investments, and as such will hover around that 50 to 59 grade range. When the 3 factors are tallied up, we get our company's final grade. Now let's talk about each of the 11 metrics and why I chose them and their purpose. Within the business factor are these 6 metrics, each given a corresponding weight based on their importance. First, growth. Growth looks at all the company's growth data and optimizes it into a single percentage, giving us the long-term growth rate of the company. The models tell us that a growth rate of 15% is considered average. Next, margins. Margins looks at all the company's dollar output data and optimizes it into a single percentage, giving us the company's output generated for every dollar it keeps for further investments and so forth. The models tell us that a margin rate of 10% is considered average. Third, operations. Operations looks at all the company's ratio data against its market price and optimizes it into a single ratio, telling us how effectively the company is running its business. Simply, is the company wasting money as it conducts its business? The models tells us that an operations ratio of 12.5 is considered average. Fourth, debt utilization. Debt utilization looks at all the debt that company has on its books and determines whether enough money is coming in to repay those liabilities. How much debt is being used to fuel the company's growth. It's optimized into a single ratio. The models tell us that a debt ratio of 0.75 is considered average. Fifth, efficiency. Efficiency looks at all the money generated from the company to see if it's using that money to grow, expand, and innovate further. It's optimized into a percentage. The models tell us that an efficiency rate of 10% is considered average. Lastly, in the business factor is market dominance. Market dominance looks at various competitive data points such as market share of primary product or services, market cap, strength of competition, and size of customer base. It's optimized into a tier ranking. The models tell us that a market dominance tier 5 is considered average. Within the stock factor are these 4 metrics, each given a corresponding weight based on their importance. First, stock performance. Performance looks at how well the company's stock has done over a 1, 3, 5, and 10-year period, if applicable, and then compares it with the same time frames as its sector and that of the S&P 500. It's optimized into a single percentage to see how well the company's stock has grown. The models tell us that a performance rate of 0% is considered average. Next are dividends. Dividends looks at how much the company is paying out to shareholders as a percentage yield, signifying a considerable and consistent income source for long-term investors. The models tell us that a dividend yield of 1.75% is considered average. Third, technicals. Technicals looks at all the chart data, focusing on the 50 and 200-day moving averages along with the stock's RSI to give us an idea of what shorter-term investors see or hope for. It's optimized as a percentage. The models tell us that a technical rate of 5% is considered average. Lastly, in the stock factor is Wall Street. Wall Street looks at the conclusive grades other analysts give the company. The data is optimized as a ratio that tells us the sentiment of what Wall Street thinks of the company. The models tells us that a Wall Street ratio of 3 is considered average. Within the price factor is only one metric, the intrinsic value. The intrinsic value figures out the fair value price of the company, using a discounted cash flow model with a leaning towards the conservative side to provide a robust margin of safety. We can answer the question, what is the most you should pay for the company? A stock price higher than the fair value price is considered overvalued. A stock lower than that is considered undervalued. The models tells us that an intrinsic value of 0% is considered fairly valued. As I further optimize my analysis, there will be some metrics and importance changes. You can see that there are no longer any employee growth, sustainability, or short interest metrics in my analysis videos. They've been either deemed redundant or incorporated into other metrics, thus increasing the importance of that combined metric. The scores may change slightly, but the ranges for a good or bad company are large enough that those slight variations aren't drastic. A lot of effort has been put into collecting, refining, and optimizing the data so that the final grade will be an appropriate reflection of a proper long-term investment. The data collection is fairly simple, but the effort to refine and optimize took around 8 months to get going. Thank you for watching this explanation video of all the factors and metrics I use to analyze these companies. Invest wisely, and as always, take care of your money.